So with the big election behind us and the new year right in front of us, we talk about this week, where do we go from here? Well, 2024 has certainly been a big year. Even as we were cresting from 23 into 24, the dominant storyline, probably still is, was the Federal Reserve. Were they going to cut rates? They were, they weren't, they could, they couldn't, back and forth we went until we finally started to get some rate cuts. Of course, the other big item still hanging out with everybody's attention was the 2024 national elections. That's in the rearview mirror. And a lot of people, I think, are left confused about where exactly we're going from here as relates to the markets for a variety of reasons. One, with the election, you saw an initial surge, then a little bit of a pullback. What did that mean? Was that really about the election? Was it not? The Federal Reserve, again, still dominating the news, and for good reason. And then, of course, these pesky valuations. So let's walk through those. First, if you took anything away from the build-up aftermath, which really showed maybe a different outcome, and then the election and the post of the election, learn this. Markets, again, as we told you in countless commentaries beforehand, really don't care about politics. Wrote a piece years ago called The Uncomfortable Truth About Mr. Market that just talks about the market's a calculator. It isn't emotional. It doesn't feel and think like you or I might do and how we might expect. Much the same, the pullback, I don't think, as much as the media's tried to spin it about Trump and cabinet and what's going on in the political scene. Again, it's really about recent CPI, PPI, inflation data showing that the Fed probably isn't going to be able to cut rates as quickly and perhaps for as long as was expected. Jerome Powell in some recent meetings and interviews has come out and said it's going to be a, quote, bumpy ride along the path to getting back to a 2% inflation, and has indicated that that neutral rate, kind of where they might stop, is going to be higher. So this is a conversation we've been having with clients a lot, especially those thinking about buying a house or a car. Where do you think rates are headed? I don't think they're headed back to where we saw them here in the early 2020s. So what are the current expectations? Well, December went from almost an 85% probability to about a 50-50 after the most recent inflation data. Most people think in January they'll probably pause. Of course, nobody knows. And then maybe a few more cuts in 2025, maybe. So while there's likely to be a lot of pro-growth initiatives, and that's good for the economy in a lot of ways, it very well could, again, continue to reignite inflation. And so that tug of war, if you will, between those two things is something for us to keep an eye on. 'Tis the season to make a bunch of calls. So you have a lot of people coming out. There's a link in the written to Goldman coming out and calling for 6,500 on the S&P. Many others making very, very bullish calls. At the same time, we call your attention to some important data. I don't know if it's quite canary in the coal mine status, but certainly some cracks in the narrative around the strength of the retail investor. Credit card delinquencies approaching great financial crisis type levels. That's not a positive for an economy, again, so dependent on retail spending, on the consumer and the service industry. The takeaway from that, again, is don't make calls. You don't need to make calls. So while the title is Where Do We Go From Here, what we really want to take you from is focusing on making calls, fixating on tech stocks, Bitcoin, whatever might be the focus of the media at any given point in time, and moving it to where is the opportunity in a longer term. And so what does drive returns tomorrow? Well, nobody exactly knows how and when markets will bear any certain pattern of returns, but we do know a few things, and one is valuation matters, and that's why so many people talk about it. Valuation is not a catalyst. It's not something that makes something go up because it's low or go down simply because it's high. Things can stay extended in either direction for quite some time. However, as we've shown, and Matt will pop up a few charts, the correlation between what price you pay for something and what type of return you're going to get out over a 10-year time frame or a 3 to 5 year time frame is pretty strong. And so what we're looking at today is not those parts of the market extended, hoping we might catch on for the last few innings of whatever ride that might be on. What we're doing instead is looking at those asset classes that are trading at valuations that, again, history would strongly suggest are going to have a higher probability of having a higher expected return over the next 10 years. If you look out at that far end of the spectrum at 28, 30 times earnings, where a lot of the market's trading, there aren't even a lot of examples of positive 10-year returns from those levels. That's each of the dots. Move down into the mid-teens, you can see both the theoretical as well as the practical results improve dramatically. Some of this risk reward was shown during the August sell-off. Again, caused in part for a variety of reasons, not the least of which was the Fed's path and inflation at that time. And you saw meaningful pullbacks, almost 10% on the S&P, 15% on the NASDAQ. Meanwhile, value stocks, real estate, fixed income, did quite well, and in a lot of cases actually posted positive returns. Maybe a prelude, again, we believe so, of things to come in the years ahead. What this rate reset, rates go up, so many asset classes got hit hard, fixed income, real estate, value stocks among them, does do is create opportunities. May not be everything for everyone. Again, we would encourage you to walk through that LIVE methodology, look at liquidity, income needs, volatility that you can put up with, expected return goals to see how it applies to you. But there's a lot of great opportunity in those. We've created 2 links in our written, one to the opportunity in fixed income, as well as a quote from Torsten Slok, who looks at $2 trillion that moved into money markets with the rates going up into cash. And as they're coming back down, the strong belief that a lot of that money is going to go try to find a new home. Particularly, he calls out investment grade private credit. So looking out and asking ourselves, where do we go from here? What does the future hold? Number one, keep in mind that your needs should be shaping your plan in your portfolio. 2, that portfolio needs to be designed for resiliency. While evaluation might suggest great investment potential, no one can successfully time the market. We don't know what's ahead, and your portfolio needs to be able to be positioned to either help you survive or even succeed depending on whatever type of market may come down the path. And thirdly, the best opportunities are rarely found where the crowd is gathered. And so broadening that horizon to see what else might be out there to help you and your family reach their financial goals. If you need help understanding more of these details or specifically understanding how they apply to you and your family, we're of course here anytime. Thanks so much.